15 large container vessels give off as much pollution as 760 million cars, and that is about to change. New International Maritime Organization rules hit January 2020 and limit the sulfur content in maritime fuel. There is a grace period, but the rules are here to stay, and you can't cheat. If you do, you pay a big fine and risk your vessel being labeled as unseaworthy. Here are your options if you're a shipper. You can buy an exhaust gas cleaning scrubber, which cleans out the sulfur dioxide. Most popular are open-loop scrubbers, but they release a sludge into the ocean. The problem? Certain countries like China and Singapore are banning them, and they come at a high price, $2 to $4 million and at least $500,000 in operating expenses a year. Or you can use IMO low-sulfur compliant fuels like diesel and marine gas oil. Analysts say demand for these could grow as much as 2 million barrels a day. The problem? Supplies. Refiners can run the U.S. light crude and get diesel, but gasoline as well, potentially creating a glut. Or they can choose heavy sour crude that comes from Canada and Venezuela. You get more diesel, but that crude is in tight supply. The result could be not enough product, too much demand, and potentially high diesel margins. Maersk says the new rule could add $2 billion onto its annual fuel bill. Okay for a company with a market cap of near $30 billion, but a deal breaker for a smaller 10 to 30 vessel shipping firm. The result? Some shippers lose money, or worse, go bankrupt, while others see their business boom from moving more product around the world. It's good for some refiners who can use lots of different types of crude. It's bad for others. Crude and product spreads go haywire, and vessels turn to alternative products like LNG. Any way you slice it, IMO 2020 has the power to change the shipping world. I recently caught up with Anthony Gurnee and asked him if the industry was really prepared for IMO 2020.
Nobody has a real incentive to be proactive. Some traders are speculating and stockpiling, but when you talk to people in the industry that handle the fueling of the ships, they basically are waiting for the demand to come. And once the demand comes, then they'll source the product. And at that point, it might be a little bit too late. We think it's going to be very, very disruptive. We think that the demand for gas oil is going to be much higher than people anticipate, and that's going to result in a lot of cargo movement around the world. Because
tanker rates are so high, tankers aren't going to want to retire their fleet to upgrade to a scrubber for IMO 2020. They want to take advantage of the higher rates.
Yeah.
A, are you seeing that? And B, what's in the implication come January 1st?
Yeah, so we're definitely seeing that, ships that were planning to go into the fourth quarter to install scrubbers, they're just earning too much money right now. So they're going to go past the Chinese repair yard where they were going to do the business and continue on to do the next load. Because in reality, even at 100,000 a day, they're probably leaving $6 or $7 million on the table by going in. As a consequence, there are going to be fewer scrubber installations, which means more demand for compliant fuel, mostly gas oil.
So how much more demand for gas oil are you thinking about versus, say, 8 months ago?
We don't know yet, but it could be quite significant because the other thing that's happening now, that generally when tanker rates are strong, ships speed up. And when they speed up, they burn more fuel. So we have an accumulation of events now, which we think are going to culminate in just much higher demand for gas oil than expected.
Walk me through sort of what this winds up meaning for your business, short, medium term.
Right. So for our business, we like to say that our ships are the taxi cabs of the world product tanker fleet, and so we pretty much go where we're needed by the oil traders and by the oil majors. So what it means for us is higher refinery throughput means more product to move. It's going to be very disruptive. It's going to result in a lot of price volatility on a very physical local basis, so there'll be a lot of cargo movement. It also means that, while the gas oil will be in demand, unfortunately a lot of extra naphtha and gasoline will be produced as well, and that needs to go somewhere. But there's going to be a big issue around what to do with the old fuel, the high sulfur fuel oil. Now, obviously, refineries will be reprocessing it to break it down into marketable products, but a lot of it is going to get stored and shipped back to the Middle East, for example, for power generation and other places. So we think that there's going to be a fairly vibrant trade admittedly for crude tankers, not our ships, but there's going to be a lot of trade around moving the old fuel away.
Where do you see the biggest dislocation then, as that thesis plays out?
There are pockets that, I think the point that we've been making for a couple of years now is that the capacity for production of the new fuels is there, but it's not in the right locations, right? So, for example, Northern Europe is always short diesel. The IMO 2020 switch is going to make that shortfall, much larger, and that's going to have to come in from somewhere. Some of it might come in from the U.S. Gulf, but a lot of it's coming in from the Far East. These are generally long distances, right? Similarly, Singapore is net short diesel. That'll be coming from North Asia and from the Middle East. So it's really a kind of a scrambling and dislocation that we think could take, the better part of a year, maybe longer, to get back to equilibrium.